Sushil, first of all, thank you for joining. I mean, we were just listening to two panels about where we are in this economy, and I think it's wonderful to now be able to marry that with both of your hats of your long experience with monetary policy at the BOE and, of course, your fund now. But to set the context of this, of the macro environment we're currently in, the panel prior was talking about the credit crunch, or whether there is a credit crunch coming and the fallout from the banking crisis. Is this recession delayed or recession denied?
I think when we talk about recession probabilities as economists, it's very important to be humble. There's a well-known study by the IMF a few years ago which looked at the ability of economists to predict recessions. And the results were pretty uncomfortable reading for economists. And I think this particular recession is even more challenging than most because of the pandemic. And I think there's a lot of evidence that the pandemic has changed the nature of this particular cycle. So if I evidence that with what people were saying, say, a year ago about what would be required in terms of higher unemployment to bring inflation down, I think it's striking to me if, say, one looks at the US. In the US, a lot of people, including me, were alarmed a year ago by how high wage inflation was. So wage inflation was 5.5%, 5.75%. And we knew we needed to get it to 3.5% to achieve the inflation target. And many of us, including me, thought unemployment would have to go up quite a lot to achieve that. Yet, we've managed to get wage inflation down to, I'm going to say, 4.25%, with unemployment flat as a pancake. The other thing we were worried about was all these vacancies around, all these job offers in the JOLTS report. So you had 11 million, and people said, beverage curve, you can't get those down unless unemployment goes up quite a lot. And here we are below 10 million, unemployment still flat. So there are puzzles there, and I think we need to understand those better before we can form a confident view about the likelihood of a recession coming from that channel. I'll pause here if I've gone on too long.
No, absolutely not.
But I'm very happy to talk about what's gone on in the banking sector as the second channel through which a recession may suddenly come upon us. On that one, I think there's little doubt that it creates headwinds. We can argue about the precise numbers. Some people think 0.25%, some people think half. Larry said something a bit more. We can argue about the size of the headwind, but the issue is it big enough to lead to that kind of non-linear change in the economy to cause a recession? And I just don't think we have enough evidence about that as yet. What I constantly remind myself of is that period starting around 1984 to 1994 in the US, where we lost more than 1,000 US banks. Sure, it was a headwind for the economy, but it wasn't primarily associated with any recession. And the 1990 recession had other causes.
First of all, let me say it's very kind of you to ask if you've gone on too long, because I can assure you everyone here wants to hear what you have to say, what not I have to say. So that's very kind. I think this question of being able to judge what the credit conditions, what the environment looks like right now is fascinating, because we see these divergences emerge. At the Fed, for example, Goolsbee is talking about the need for patience to pause to wait because of the impact, while Bullard is saying, look, credit conditions are fine. We can keep hiking. In this environment of the unknown, what signals do you look to? What data do you look to try to get an understanding?
I think it's appropriate to recognize that the end of any tightening cycle is much more difficult to navigate for both central bankers and portfolio managers alike. And something that we have built into our quant models for years is that we typically tend to take risk down in the latter stages of a tightening cycle, because we recognize that often tightening cycles end with financial accidents. Financial accidents typically involve either known unknowns or unknown unknowns. They occur at an unpredictable point, and therefore I think it's even more important than normal to run lower levels of risk. And the corollary of that for a central banker is this old-fashioned notion of brainard uncertainty, that when you run into that situation, your moves necessarily as a central banker must become smaller, and you must move more cautiously. I think that certainly would be more prudent at this point for central bankers globally.
So if the result of the unknown in the end of the cycle is taking risk down, does that also correspond with inability just to have any high conviction trades? Is that possible in this environment?
No, I think what needs to happen in this sort of environment is you need to become more agile and more tactical. And what we have been trading are oscillations in the probability of a recession as priced into markets or as seen in consensus surveys. I mean, remember, the latest reading I saw of the Bloomberg consensus survey for the probability of a recession, it's quite high, it's 65%. And the key thing for us is to trade, whether it's going to go higher or lower. And that's actually of more interest to me than, whether 65% turns out to be the correct and appropriate number. For what it's worth in terms of where we are in terms of the banking situation, in many ways, this environment reminds me much more of the panic we had after LTCM in '98, and also the hyperventilation we had in 1989, in the spring of '89, about the S&L problems in the US, than it does remind me of the GFC.
So it's not the proximate cause of recession, is basically what you're saying, if that's what it reminds you of.
So I think that is likely, in the sense, the only reason I hesitated when you said that is that clearly it's a headwind, and it could be the sort of final straw that broke the camel's back. But I don't think it's the primary precipitating factor that one should be looking at this stage.
Well, if you look at how markets reacted, just looking at the front end of the curve, getting it to move in 3 days a full percentage point, usually a move like that is indicating, okay, something is really wrong with this economy. But maybe not, because it was really the only asset class to experience that type of volatility. What do such ferocious moves, such volatile moves in this bond market tell you?
So, I mean, you're spot on. I mean, the size of that move was on par with what we saw around 9/11, what we saw around the 1987 crash. And then the question you have to ask yourself is it warranted by the underlying fundamentals, or is it an overreaction? My preliminary analysis suggests it is an overreaction. And I think the overreaction came from the fact that going into it, there was significant positioning by what you might loosely call the speculative community. And remember, the speculative community ultimately represent weak hands. So they're governed by stop losses, they're governed by VAR limits, and there's certainly plenty of anecdote of people in various organizations being sent home, i.e. their capital allocation being taken away completely from them and then being sent home and told to go and have a holiday or even fired. But essentially, when you get that type of self-feeding behavior in terms of price. So lower prices actually essentially led to more selling of the two, more higher prices of two-year futures led to more buying. Right. So essentially you ended up in the very short term with a perversely sloped demand curve, and that we know leads to considerable instability. I mean, my favorite analog for this is actually what happened in the 1987 stock market crash in terms of what portfolio insurance then did to demand curves. So you had something very similar on March 10th and 13th in terms of what happened to demand curves in the very short term. And we know that when demand curves get perversely sloped, you can get very considerable price instability. And that's what I think happened. I think there was a little bit of news, and then it was vastly amplified by the sorts of channels I just talked about.
Right. And now we've settled in a range of, where a market maybe is complacent, would you say? If we're at around 3% and the 10-year yield, that's quite some confidence that central bankers will get inflation under control. Do these levels make current sense to you? Is that sort of mispriced based off of stop losses, these sort of weak hands? Has that played out, or is this a bond market that you still want to be short?
So if I start with the easier instrument, which is the two-year instrument, and I'll then come to 10 years, if you'll allow me. So in the two-year area, it seems to me what's going on is essentially most investors I speak to are thinking of it in bimodal terms. So I think there'll be, people, for their most likely scenario, broadly agree with the Fed. So their most likely scenario is that the Fed will tighten 1 or 2 times, and then will essentially pause. But because of the importance of these unknowns in the financial sector, I mean, people essentially have this gnawing sense that if interest rates were kept low for so long and a lot of financial engineering happened, then there might be skeletons that they don't know about. And because of that sense of fear, which got amplified by the SVB news, because remember, that was the second thing after the gilts crisis in the UK. So people think that there's other stuff they don't know about. They feel that they need to price in some tail risk probability of a really dire outcome. And that really dire outcome would lead to very quick Fed easing. So if you think of what January Fed funds futures are pricing, Jan 24 Fed funds futures, they're pricing in a cut in interest rates of 65 basis points. Another way of 65 basis points from the hike in May, by the way. Yeah. So another way of interpreting the 65 basis points number could be that there's a 30% probability that something horrible will have happened, and the Fed will have had to cut 200 beeps, and a 70% probability that they do nothing between May and Jan. Now, as market participants, we can argue about whether 30 is too high a number. But I think that's where the argument lies now.
Okay, so in other words, it's too simplistic to say the market is expecting 65 basis points of cuts. How could that be the case? If we're cutting, it needs to be much worse. Is that argument then too simplistic?
So I think you put it very well. I think essentially we've got these two scenarios. The more likely scenario is that we essentially follow the Fed's current forecast, with a little bit of noise around it. The less likely scenario is a tail risk does eventuate, and then they have to cut massively. Now, obviously, the longer you go on without the tail risk eventuating, the more likely it is that two-year yields continue to go up. Remember, already since the 13th of March, they've retraced a decent chunk. And if you don't get any bad news, I think 2-year yields just continue going back up.
So this
at least part of the way.
Right. So this period of volatility, I mean, last year, a lot of macro funds, a lot of systematic macro funds were really the stars of the hedge fund world. And this year definitely complicated that because trend following is difficult if there is no trend.
Yes.
Are you expecting some of that to normalize, or does this continued environment where there's so much uncertainty, does it continue to be problematic for the more systematically, maybe trend following correlated strategies?
Okay. I mean, what's really interesting to me is, and I went back and looked at some data for the 1970s for the trend following sector. I don't have that slide here, so please forgive me. I didn't anticipate this, but I did go back and look. And essentially the message from the 1970s for the performance of trend followers is that it was 2 steps forward, 1 step back, right through. And I think that's not a bad template for what's likely to happen over this period. So 22, as you say, was a great year. And it's almost inevitable that when you get to these latter stages of a tightening cycle, that you will see some setback, because all these strategies ultimately are probabilistic. What you're relying on is a somewhat superior win-loss ratio or a somewhat superior way of risk management. I mean, we know with trend following, your win-loss ratio is 50-50, and you make money in essence because you let your winners run and you cut your losers quickly. With systematic macro, you aspire to a higher win-loss ratio. But if I look at our own win-loss ratio over 20 years, it's about 62-38, not fantastic. So with a 38% chance of being wrong, you are going to get some setbacks.
Okay, well, let me tee you up for a slide I know you do have. Compare that to me with a traditional 60-40 portfolio.
Yes. So, I mean, the key thing I say to clients is that in this uncertain world where we are uncertain about many things, including the durability of economic relationships, it's very important to have some diversification. And sure.
This one or the next one?
No, it's okay.
This one? Okay.
So essentially what this slide is supposed to be showing is essentially if you look at periods where 60-40 portfolios did particularly badly, and we've picked the top 10 worst ones, then in those periods, trend followers meaningfully outperformed a 60-40 portfolio. I think something's gone wrong here with this chart. So we're going to have to replace it.
There's some numbers floating in space there.
Yeah, there's some numbers floating in space. But, I mean, the big picture message is if you look at the 10 worst periods for a 60-40 portfolio, and in the last 50 years, and I think 2022 was only the 3rd worst. You were down about 16%, and trend followers were up over 25%. So massive outperformance. You saw that in the 1970s as well. There were 2 episodes in the 1970s where trend followers massively outperformed a 60-40 portfolio. And the thrust of my argument is that you need diversification in your portfolio, and one of the good places to find it is trend following, systematic macro, discretionary macro. They're all country cousins of each other, and they tend to give you decent diversification relative to a 60-40 portfolio. And remember, 60-40 portfolio tends to be highly correlated to most conventional portfolios. And there's a second point I'd want to make, which is that 60-40 portfolios typically struggle during a recession, while trend following and its country cousins tend to do well during a recession. And that, I believe, is for 2 reasons. One is that conventional markets exhibit significant herding behavior. and also suffer from behavioral biases. And therefore, conventional portfolio allocations tend to be very slow to move, while these other strategies are able to exploit that.
You know, every time there's a period of market volatility, it seems like there is some sell-side analyst who likes to blame CTAs, that likes to blame trend following for exacerbating market sell-offs. Do you think those arguments are accurate typically?
So I'm sure CTAs played some role in the overreaction of two-year yields this time. Mm-hmm. So, but they were only a part of the picture. In terms of anecdotal evidence, there were many, many other people caught out who had to go in for a VAR reduction, and therefore they amplified that. I keep saying sell-off. What I mean is buying of two-year futures in this case. So in certain episodes, unquestionably, yes. In certain episodes, they can be playing the opposite role. So and in terms of playing the opposite role, I'm talking less about trend followers, but more about systematic or discretionary global macro, who often do play a stabilizing role. Right. You know, certainly systematic and discretionary global macro were almost first out of the blocks after LTCM in recognizing that this wasn't likely to be a real recession. Many other people followed after.
How has the space changed in terms of size, in terms of strategy? Because when we're looking at a slide like this that says managed futures, obviously that bucket is massive of what types of strategies have been in there. There have been periods where managed future strategies have been popular, less so. Where do we stand at the moment in terms of sophistication, diversity, and popularity of managed future strategies?
Okay, so in terms of popularity, you wouldn't be surprised to learn that it essentially is a function of last year's performance.
Right.
It's a sad truth. I always say to clients that these are strategies you have to embrace for the long run. They make sense in your portfolio allocation. You know, if you ran sort of standard portfolio optimization exercises of a 60-40 portfolio with managed futures attract something like a 20% allocation. Most people, you'd be lucky to see them having more than 2%.
Right.
So they're massively underinvested, this sector. And there does tend to be this tendency to follow last year's performance. Now, if you were listening when I said 2 steps forward, 1 step back, the corollary of that is often people come in at exactly the wrong time. So a lot of people came into the sector sort of after the 2008 crisis, where the sector did incredibly well, and then came in for that little period of mean reversion you tend to get in performance. I've certainly been saying to people that this time round, I think the degree of macro uncertainty and instability we have makes this a period more like the 1970s than a period like 2008 to 2010, because in 2008 the central bankers were able to come to the rescue. This time I think inflation will constrain the degree to which central bankers can come to the rescue, and I think there'll be more scope for these strategies to do well.
I do want to open it up to audience questions. We only have a minute or so left, so if there are none, we'll just do final questions up here. But before I do that, anyone out there have any questions?
Hello, thank you. Chris Marati from Pareto Economics. How would you price in geopolitical risk in your analysis?
I'm sorry?
How do you price in geopolitical risk and also the foresight of potential geopolitical risk, which is very uncertain in its impacts to global markets, into your markets?
Okay, so I can tell you what I do. I can't represent the whole sector on that. So in terms of what we do is we rely on surveys of so-called experts, which we buy in. So we have a panel of experts and we rely on their views quantitatively because we can then track it over time as an input into our models. It's certainly been very helpful. They were very good in December 21 and Jan 22 in terms of warning us about the Russian invasion of the Ukraine. And we fed it mechanically into our models, such that by the time the sad invasion happened, our models had repositioned to a meaningful extent, expecting the invasion. So that's one way to do it. We are obviously somewhat constrained because we tell clients that we follow a quantitative process. But so far so good, I would say. They were also actually pretty good about warning us of the how bad the pandemic would be. So they were telling us at the end of January 2020 to prepare for lockdowns, which was much earlier than the UK government.
Out of curiosity, how often do you have to do a, if you will, human override to your strategy? Is that frequent, infrequent?
So the process I just described is my best substitute for a human override. I much prefer to use that because, the key thing about it is if you're serving them regularly, you've then, you've got the advantage of their expertise, and B, they kind of tell you when to go in and they tell you when to get out as well. So, we're continuing to survey them on possible peace in the Ukraine. So, because we will need a cue to get out of some of those trades. I mean, we've got out of many of them, but, there are still some views embodied in our models which are predicated on the conflict continuing. So we are definitely going to need a hint if the conflict's suddenly coming to an end.
Is there one more question? All right, I think everyone might be hungry. Sushil. Please, everyone, join me in thanking Sushil so much.